Greetings from New York City, everybody. Every week I take 10 minutes to help you connect the dots by giving a quick review of what's going on in the real economy, the mortgage market, and the real estate world. The big news this week is the announcement from FHFA that any Fannie or Freddie loan that enters forbearance can do so for 12 months without penalty. So that is a solution to about 60% of all the mortgages, so approximately 40 million mortgages across the country, where homeowners who are in distress do not need to make a payment for the next 12 months, and those missed payments will be added to the end of the loan. It's not clear what evidence the homeowner needs to provide that they have actually been impacted by the pandemic, but that will, I guess, come to light over the coming weeks. It removes what was a major overhang on the real estate market and the mortgage market because, as I mentioned in previous videos, loan servicers had been on the hook initially for all missed payments, and then most recently just the most recent 4 payments. And now it seems there's a deal been struck that they can forbear on 12 payments. The servicer will pick up 4, and I'm guessing the Treasury will pick up the remaining 8. Still a big problem in residential demand, but at least the curve is starting to change. So I just plotted here the latest developments from around the world and in every market, with the exception of, unfortunately, our friends in Brazil. The curve is trending down. So the number of new cases is going down, the number of deaths is going down. Every death is, of course, a tragedy, but at least the number of deaths are going down. Certainly in New York, we're starting to see slight signs of the marketplace starting to reopen. It's still more or less a ghost town, but some people are starting to come back. I believe the latest reopening date is the end of next week, sometime around the 16th. And we'll start seeing people back on the streets in Manhattan. So by the time I update you next time, I'll have more news in that regard. In terms of unemployment, one of the last times I spoke to you, I shared this chart from DoubleLine, and it suggested that up to 35 million jobs were at risk. Well, they were pretty accurate because it ended up, I think, peaking at 33 million, and we're just now seeing some decline in unemployment numbers. This number came out 2 days ago, and we saw new claims down to just over 3 million, or just under 3 million, I should say. The consensus was for 2.5 million, so not as good as everybody hoped, but still, at least we got a decline. In terms of what's going on just generally in the real estate market, there was a great interview this week with Glenn Kelman. He's the CEO of Redfin, and if you can find the interview on Google, you'll find it on YouTube. It's about 7 or 8 minutes long, but just to hit the high notes, there was a few things he said. Firstly, he said that all sellers in April were forced, so we saw a big fall in headline prices in that month, and they were distressed sales, people who had to move, coming to the market. Inventory in April was down about 25%, but the number of people searching for residential real estate did not change. And it seems like we're seeing more of a barbell type of recovery. Those people who have cash, who want to move, who have their financing in place, are doing so. And the rest of the people who do not have that cash and don't have financing in place are seemingly priced out of the market. And particularly in New York City. I'll come to New York in a second. He also made a couple of interesting points, which were on his website, which is redfin.com. It's one of the large public real estate brokers here in the US. Most of the searches are from conurbations like Boston and New York and DC, searching to move to places like Charleston, North Carolina, Boise in Idaho, and Madison, Wisconsin. And I've been to all of those cities, and they are much more bucolic, non-residential downtown type cities, more like more countryside or semi-rural, I think people would describe them as. Beautiful cities, college towns, and wonderful places to live. And I'm wondering if what I mentioned to you on a previous video is actually applying on a more wide scale than even I imagined, which is people really zero basing their business. Do I really need an office? Do I really need all of those people? Is there a way that I could operate the same business remotely through telecommuting, or maybe through a shared space like a WeWork type setup? So it'll be interesting to see how that plays out in the next weeks and months as people come back, certainly to New York City. He also mentioned a lot of stress in the Airbnb and vacation market. I know that anyone I know with second homes who rent them have found that their season has basically disappeared this year as people are not traveling. Carrying that theme forward to Manhattan. Similarly, I spoke to a few brokers this week, both on the mortgage side and on the end product. And just a couple of highlights from them. Firstly, credit markets way tighter for jumbo mortgages. That's anything above $750,000. Now, the average mortgage in New York, I'm not an expert, but it's about $1 million, maybe a touch more. So that's only available to people with a 700 FICO and 20% down. So you need a 700 FICO and at least $200,000 in cash. And that has flowed through to the market. So they're seeing a lot of purchase contracts cancelled. In Manhattan, it's not unusual to put 10% down, and if you don't complete, that 10% goes to the seller. So you need to tie up the property with a significant down payment. And what's happening is he was estimating about 100 contracts cancelled in the last month. And he's from one of the larger brokerages. That would be a very significant cancellation rate. But the buyer's going back to the seller and then trying to renegotiate at a price that's lower than the 10% they would have lost. So they're estimating a 15 to 20% fall, particularly in real estate in Manhattan above $3 million. Now, Manhattan is not America, but it's not representative in any way, but it's interesting to see that kind of a price fall in that, I guess you would call it super luxury real estate market. In terms of what's going on in the banks, also interesting seeing banks exiting from whole loans, because remember, a lot of these loans are going into forbearance and moving that capital into mortgage-backed securities. So some excellent analysis from Recursion. Lee Chong over there, they're an analytics house on mortgage and well worth following them and following their blog. Some excellent analysis there. But not surprisingly, banks getting out of whole loans and into mortgage-backed securities frees up their credit lines, and a number of internal accounting advantages and risk reduction strategies for them. I mentioned last week, and we're seeing more evidence of it now in terms of refinancing. So purchase money mortgages have been in decline, and again from Recursion, refinancings now about 60% of all new mortgage-backed security issuance, and I think we'll see that continue into the foreseeable future at least. In terms of deal flow, we're not seeing too much in the way of deals. Any of the deals that we were working on have either now closed, which were all small deals, or they're really on ice, and the bid-ask spread is so large. It was 200 basis points, 300 basis points. It's now 700 or 800 basis points, so 7 or 8% spread between what the seller will sell at and what us as the buyer will pay. So I don't think there's going to be any deals for a while, and with that forbearance agreement from FHFA, I think that the expected flow of non-performing paper onto the market is probably going to be postponed for several months. Remember, FHFA only covers the top 60%, maybe 70% of the market. There's still 30% that non-QM, what would have been called subprime. There's no plan to solve for those loans right now. So they may well come to the market. So in summary, real estate shopping way down, refinancings way up, people looking to see, do they really need to stay in big cities, and certainly looking to see, could they recreate their businesses in places that are less dense, where they're not traveling on subway and working elbow to elbow with lots of other people. So that's all the news for this week. I'll join you again next week. Have a great weekend and stay safe. Hopefully when I speak to you next week, you'll hear the bustling office of everyone back at their desks. So see you then.